I'm University of Illinois Extension's Todd Gleason. We're talking today with Tom Tracy. He's the president and CEO of First Credit Illinois. Tom, thanks for being with us. Celebrating the 100th anniversary of Farm Credit here at the Illinois State Fairgrounds. Tell me about it.
Yeah, Farm Credit Illinois, we serve the southern 60 counties here in Illinois, and we're the descendant organization from over 50 production credit associations and federal land banks, and so we're very proud to be serving the needs of over 8,500 members here in the southern 60 counties of Illinois. We're going to have quite a dinner tonight. We're expecting around 800 folks in for dinner and a celebration. This kind of is the final event in a year-long series of celebrations. I mean, we even had a Farm Credit system-wide event out in D.C. where we sent several of our younger farmer members out with many of the products that are grown right here in the southern 60 counties in Illinois. And it was a pretty educational moment, I think, for a lot of our politicians, those that are maybe not as much from the rural areas like the congressional delegation we're all familiar with here, but it was a great opportunity to get to showcase some of the very healthy, very good products here from Illinois. And so that tonight will be the final event in a year-long series of celebrations marking the 100th anniversary of the Farm Credit System and Farm Credit Illinois.
Let's get on to some of the business of the day. Okay. We know from Gary Schnitke that this is the third, and it looks like it's going to be a really pretty rough year for farmers based on price. They should have a good crop. However, low prices. How much concern do you have? What do you think production loans will look like going into the coming year, and bottom lines for farmers as they pull in a crop that's not worth a lot of money?
Well, certainly, we review Professor Schnitke's work as well, and of course with our loan portfolio, being such a significant ag lender here in these southern 60 counties of Illinois, we see it as well. We had a number of years there that were really record years for agriculture, the golden years, many people are calling them, and the adjustment into this efficiency cycle, which is what we're calling it, has been difficult. But one of the things that we've seen, certainly going into the cycle, was our members were in incredibly strong positions. Their balance sheets were very liquid, lots of working capital on hand, a lot of equity. Of course, as well as anybody, the rate of increase in farmland values over the last 7-8 years. So going into this cycle here a couple of years ago, went in very, very strong. Of course, Farm Credit Illinois, as a member-owned cooperative, could not really be in a stronger position. Over $4 billion in assets, over $800 million in capital, very conservatively managed farmer-owned cooperative. And so what we've seen here over the last couple of years is it's become more pointed, it's become more difficult, and we're seeing people really manage costs very, very tightly, managing inputs where they can manage inputs. We've seen some input price relief as the demand has waned a bit, and now we're getting into the stickier areas, cash rents. It's time to see probably some more reaction on the cash rent segment of the expense sheet versus what we have seen. Cash rents have stayed relatively sticky, as you know from Professor Schnitke's work. He's talked about that as well, and it's really time for us to make those final adjustments to get this cycle all the way through. So that's where we're at.
Are you, as an organization, Farm Credit, willing to help farmers negotiate lower cash rents with their landlords?
Well, we don't get involved in the actual operating decisions, but of course we will be very frank and transparent with our members as we review their financial situation with them. Our loan officers, our crop insurance risk management specialists that are out there, very passionate about helping all those farm families succeed. And so, we have very in-depth discussions with all of the members of our cooperative about current conditions, what their forecast for the next year looks like, and that, then we talk about what's on their mind, what it is that they're trying to do, what changes they're trying to make. And what we've seen, honestly, Todd, for the most part, is we don't really, not only do we not play that role, we don't need to play that role. I mean, when you look at the business acumen level of a farm operator, agribusiness owner of today, it's on par with, any Fortune 500 CEO that's out there. You've got to understand currency exchange rates, global trade, commodity demand, all on top of being a great agronomist and producer, farm manager. So They're already there. They're already having those conversations. Now, I think the degree to which they're getting a reaction from those conversations is going to have to change, and I think that's all. We're already beginning to see some glimpses of that. We've seen some softening, very minor, to the tune of $10, $12, $15 on average on cash rents. But now we're beginning to see land prices pull back. We're looking at our most recent land study, and we've seen a 6 to 8% decrease in land values over the last year. So that's not saying a whole lot when we've adjusted to where we were 18 or 24 months ago. I mean, which was significantly over where we were 12 months prior to that. But what's happening is land prices are foreshadowing that need for change in cash rent.
Going forward, where do you see land prices moving to?
Well, it's always hard to predict. As you know, land prices are tied very strongly to commodity prices or cash rents. And then you couple that with interest rates. Well, interest rates have remained very low, so they've been a somewhat stabilizing force here for the farmland values, even while in the face of commodities pulling back. So you couple that with a lot of strength in the balance sheet that is now beginning to erode a bit, both on the working capital front and to a lesser degree on the equity side, and you're gonna begin to see that the sensitivity of farmland values to conditions in agriculture is going to become more pronounced as it used to be. So there definitely is some room for further adjustment from here.
How important is crop insurance as a tool or part of the portfolio, either one, for a producer?
We think it's incredibly important. Not many businesses have an opportunity to essentially ensure that such a significant part of their production. It certainly does unfetter the producer to make some marketing decisions, perhaps be quite a bit bolder than they normally would be. When I was a kid growing up, you didn't hear guys talk about pulling the trigger on 70% of their anticipated crop. And you don't hear that a lot even today, but you hear people making significant sales even earlier into the cycle than I think was more commonplace years ago. And so crop insurance is not only as a risk management tool, but as a way to give you an ability to take a little bit more risk earlier in the cycle is really important. If you look at this year, that perfectly illustrates the value of that tool. We had a window where we had significantly better prices on both corn and soybeans. Now, soybeans have hung in there a little bit better than corn, but if you had crop insurance in place and it gave you the confidence to make a relatively larger sale, that could have a tremendous impact on how this year comes out for you.
And finally, it's an important tool for producers, part of their portfolio. It's also part of Farm Credit's portfolio.
Absolutely.
How important is it to the Farm Credit system's bottom line?
Well, from a producer standpoint, it's incredibly important. And that's the exact same reason it's incredibly important to the Farm Credit system. So, when you look back at 2012, that drought year, we saw hundreds of millions of dollars come back in the form of payment down on operating loans, term payments on land loans, and that came primarily from crop insurance. That was a devastating drought year, and without the crop insurance program, that would have been much more difficult for the farm families here, certainly in the southern 60 counties of Illinois, but more broadly across the Midwest. So what you have there in crop insurance is a public-private partnership. You have private dollars going in there, as well as some public, that works perfectly as designed by Congress. It is the safety net, and it works very, very effectively, and we certainly saw that. That really helps Farm Credit from the standpoint of being able to anticipate repayment rates in our portfolio, and it helps those producers to maintain their balance sheets.
Well, Tom, thank you so much.
Thank you very much, Todd.
Tom Tracy, of course, is the president and CEO of Farm Credit Illinois. I'm University of Illinois Extension's Todd Gleason.